When you have the money in your bank account, the first question that you ask yourself or you ask your advisor is, where should I invest the money? Well, before we answer that question, let's look at what are the various investing options available to you as an investor. The various investment options available can largely be divided into financial assets and physical assets. Your financial assets would largely consist of cash, which includes your currency notes, your savings bank account, your online digital wallets, overnight mutual funds or liquid mutual funds. The second set of financial assets would consist of debt, which is largely your EPF investments, your PPF investments, your fixed deposits, corporate deposits, your investments in bonds, debentures or in debt mutual funds. The third category of financial assets would consist of equity investments or investments in shares or stocks, investment in a PMS scheme, investment in equity mutual funds or ETFs, or which are known as electronic traded funds. Your physical assets would consist of gold, which would include physical gold, investing in gold mutual funds or a gold ETF, or the popular sovereign gold bonds. Physical assets would also include investment in real estate, which can be investing in land, a residential property, a commercial property, or investing in real estate through the non-physical route, which is your REITs or REITs, real estate investment trusts. Now, the reason why we have these asset classes is because the return expectation from these asset classes varies quite a bit. So if you look at the return expectation across the 5 asset classes, the average return expected from investing or holding cash is 3.5%, which is the returns you get from putting money in your savings account. Your average returns from debt products is about 8%. Your investments from equities yield approximately 16%, though they are very diverse and they vary a lot, but they yield an average of 16% on an average historically over the last 2 to 3 decades. The average returns from gold is about 9%, and finally the average returns you can expect from real estate is a range of 8 to 20%, because the returns that you get from your real estate investments are extremely location specific. While these range of returns in percentages may not make a lot of sense to you, if this is converted in the form of what can I expect as an investor if I put aside certain money over a long period of time, the end corpus that you get by investing in these asset classes should be a good benchmark for you to understand why you should be investing your money in a particular asset class and how you can build a portfolio with all the asset classes in it. So if you were to put aside an amount of 5 lakhs for a period of 30 years in your savings account at a 3.5% rate, you will land up with a corpus of 14 lakhs at the end of 30 years. A fixed deposit of 8% will yield you 50 lakhs at the end of 30 years, whereas investment in gold at 9% will give you an end corpus of 66 lakhs at the end of 30 years. If you land up earning an average return of 12% on your real estate investment, that will give you a corpus of 1.49 crores at the end of 30 years. Whereas if you invest an amount of 5 lakhs into equities and at average return of 16% for 30 years, you will land up with a corpus of 4.29 crore of rupees. So you can see that the returns that you get from these asset classes vary quite a bit when you look at one asset class and want to differentiate it from the other asset class. Obviously, if the returns vary a lot, what comes with each asset class is the risk associated with each asset class. Now, what do we understand by risk? The simplest definition of risk is variability in return. So when you invest in a particular asset class, if you are not able to get the return that you expect when you invest in the asset class, the returns vary quite a bit. That is the risk associated with the asset class. Obviously, the risk associated with debt is much lower than the risk associated with equities, because you do not expect that much variability in returns when you invest in a debt product like a fixed deposit, whereas when you put the same money in a equity share, you should be ready to live with a huge variability in the returns of such a risky asset class. The second major risk associated with investing in any asset class is the loss of principal itself. That is, forget the variability of return. There is always a risk that you may not get back the principal that you invested in these asset classes. And the third risk which is associated with investing in any of these asset classes is the lack of liquidity. That is, not being able to sell a particular asset class and convert it into cash when you need the money the most. And if you look at the 5 asset classes, while equity is the one which is expected to suffer the most from a loss of principal in the form of risk, the asset class which suffers from lack of liquidity is real estate, because it takes quite some time to convert the real estate into cash, and it is possible that you may land up having to spend quite an amount of money just to convert this real estate into cash. That is, your transaction cost itself is pretty high, resulting in a lack of liquidity for real estate as a asset class. Obviously, each asset class comes with its own baggage of risk and returns, and you can enjoy a good relationship with money only when you are ready to take up the risk associated with the investing of money in these various asset classes. One basic principle or investing rule that will live with you forever, whether you invest as an individual or as a couple, whether you invest early in your life or late in your life, is the principle of low risk, low returns, high risk, high returns. This is a fundamental principle which you should never forget, and this is a principle which you should go back and visit each time you find an instrument which is offering fantastic returns. Any instrument or any asset class which is able to offer you high returns will always have high risk associated with it. There is no product which ever existed or which will ever exist which can offer you high returns but will come associated with a low risk. If we were to map all the 5 asset classes on our risk pyramid, you will find that cash is the least riskiest of all the asset classes. Then comes debt, then comes gold, then comes real estate, and finally equities. So the asset class which is the least riskiest is also expected to give you least returns, which we saw in our returns chart, and the one which is the highest returns is the one associated with the highest risk. While each asset class has an associated risk and return with it, each asset class has its own importance or role to play in your portfolio. Cash in your portfolio is held for emergencies, or it is held when you do not have investment opportunities which suit your risk appetite, and you want to hold on to cash when you are waiting for good investment opportunities. Debt as an asset class is your safety net, and it is the place where you invest all your money, especially for your short-term goals, and it is the place where you invest all your money if you are an extremely risk-averse investor. Gold is an asset class which helps or kind of counters the volatility that you find in equity. So historically, gold and equity have an inverse relationship. When equity does well, gold does badly, and when equities fall, gold becomes the go-to asset class, and that helps you manage the volatility or the risk of investing in equities. Real estate is a fantastic asset class to help you build a monthly income portfolio, because the rent that you earn through the rental of the properties helps you take care of your regular monthly requirements, in addition to the fact that the appreciation in the value of the property can be of a huge bonus to the rent that you earn on a regular basis. Equity as an asset class is the go-to asset class for wealth creation, because apart from real estate, that is the only asset class where real wealth creation happens over a long period of time. So we understand that each asset class has a certain role to play in your portfolio, and that is why you as an investor, whether an individual or a couple, should have your investments in each of these asset classes. To learn more about these asset classes, to learn more about the various investment options of each asset class, to learn more about the various products in which you can invest, to learn more about the risk and returns associated with each asset class, I would highly recommend that you go back to our course, which is Namaste Money 103, which talks about all these asset classes and deals with each and every asset class in pretty much detail. The focus of the course we are looking at now is to understand how you can invest in these asset classes as a couple. But to understand each of these asset classes, I would highly recommend that you go back and have a look at our course Namaste Money 103 Basics of Asset Classes.